something just snapped in the silver supply chain. And it didn't start in a mine or a mint. It started in government offices and policy meetings and in the quiet decisions that never make the evening news. If you own silver, if you use silver, or if you're thinking about buying it, you need to understand what just happened, why it happened, and what it could mean next. Because the next move might hit the market when almost nobody is ready. Here's the headline in plain English. Governments are waking up to the strategic value of raw materials, and silver sits right in the crosshairs. Not because it's shiny, not because it's a hedge, but because modern economies literally run on it, and once governments treat a resource as strategic, the rules of the game change fast. In this video, I'm going to break down the chain reaction you're watching unfold in real-time political pressure on central banking. The fragile confidence that holds paper markets together, the growing gap between paper and real silver, and the supply pinch that shows up first at the retail level, then spreads everywhere. We'll also connect the dots on export restrictions, rising exchange requirements, and why Asia is paying more for metal that the West still pretends is abundant. And before we dive in, do me a quick favor, hit subscribe so you don't miss the next update. This story is moving week to week, and the people who wait for the recap usually pay the highest price, literally. Now, let's start with exactly what happened. Over the last several days, the market has been forced to confront a simple truth. The independence of central banking isn't as solid as people assumed. When political leadership starts leaning on monetary policy publicly, repeatedly, and with real consequences on the table, investors stop pretending the referee is neutral. And the moment that illusion cracks, money moves. That's why you're seeing precious metals catch a bid, even when headlines try to frame it as irrational or speculative. It's not irrational. It's not even complicated. If people believe monetary policy can be bent by politics, then they also believe currency can be bent by politics. And if currency can be bent, it can be devalued. That's when gold and silver stop being assets and start being escape hatches. But here's the part most people miss. Silver isn't just reacting to the currency story. Silver is reacting to the supply story. Because the supply story is now being driven by geopolitics, not just geology. We used to talk about a globalized world where supply chains were inefficient but predictable. That world is fading. The new reality is strategic control, strategic stockpiles, strategic trade policy, and strategic denial. In other words, the market isn't just asking how much silver exists. The market is asking who can access it, at what price, and under what conditions. And when that question becomes the real question, the paper price starts looking like a suggestion. So let's talk about the first domino, debt. The real engine under everything you're seeing is the debt burden. Governments, households, corporations, take your pick. The system has accumulated so much debt that tightening policy in a meaningful way becomes politically and economically explosive. When interest costs rise, something breaks. When interest costs fall, currency confidence erodes. The system is boxed in. That's why every solution looks like a delay tactic. Refinance, roll, extend, print, disguise, redefine inflation, blame external factors, rinse, repeat. You can call it management if you want, but it's management of decline. And this matters for silver because silver sits at the intersection of monetary fear and industrial necessity. Gold is the financial alarm bell. Silver is the alarm bell and the wiring inside the building. Now, some people keep pointing to past blow-off tops as if history repeats in neat little loops. They'll say, this looks like that year, and then they'll try to time the top by watching a chart. But the real difference today isn't the shape of the candle. The real difference is the structure of the system. Decades ago, debt-to-economy ratios were lower, derivatives were smaller, and the financial plumbing was simpler. That meant that policymakers had room to hike rates sharply without instantly detonating half the balance sheet of the modern economy. Today, that room is basically gone. If you try to force rates high enough to crush real inflation, you don't just slow spending, you threaten solvency, and if the system cannot tolerate the medicine, then inflation isn't cured. It's managed. It's reframed. It's not that bad. It's transitory. It's supply driven. It's someone else's fault. So meanwhile, the currency buys less. So when people say, I'm going to take profits and go to cash, I want you to pause. Taking profits can be smart. Rotating can be smart, but selling real assets to sit in a currency that is designed to devalue is like winning a race and then deciding to celebrate by walking back to the starting line. Here's a simple way to think about it. An old silver coin contains a fixed amount of metal. The face value printed on it doesn't matter. What matters is what it can purchase. Now ask yourself, do you really believe the world is going back to a place where metal becomes worth less and paper becomes worth more? Or do you believe paper will keep being created faster than real things can be created? That question isn't about predicting a day, it's about understanding direction. Now, let's zoom in on the supply side, because this is where things get spicy. Retail shortages are usually the first visible symptom because retail is the last priority. When demand surges, big players get served first. Industrial users, sovereign buyers, institutions with relationships, and whoever the system decides is strategic. Retail gets whatever is left, and retail gets it late. That's why you see delays on popular products, sudden premiums, allocation policies, and weird gaps where something should be available but isn't. And it's why you see both buying pressure and selling pressure at the same time, yet the logistics still jam up. It's not just about demand, it's about flow, and flow is being disrupted. In multiple regions, governments are tightening their grip on critical inputs. Some do it loudly with formal export controls, others do it quietly through licensing rules, shipping restrictions, and temporary measures that never quite expire. Either way, the result is the same. Less metal moves freely, and the metal that does move carries a higher strategic premium. Now, you might be thinking, okay, but there's plenty of silver above ground. Sure, there's also plenty of copper above ground inside walls, inside electronics, inside infrastructure. Above ground stock doesn't mean accessible stock. It means dispersed stock. It means locked up stock. It means stock that would require higher prices to coax it back into the market. And this is the part where silver behaves differently than most people expect. Silver is cheap enough that people treat it casually, but important enough that industry cannot simply substitute it away. The moment demand spikes and supply tightens, price has to do the heavy lifting. Price is what rations the metal. Price is what tells holders, let go. Price is what tells recyclers it's worth it. Price is what tells miners, expand. Without higher prices, the shortage doesn't resolve, it deepens. So, when you hear the shortage is temporary, remember temporary shortages can last years if the incentive structure is wrong. And this brings us to the tug-of war between paper markets and physical markets. In the West, a massive chunk of silver trading is not about moving metal. It's about moving promises, contracts, claims, leverage, spread bets. That ecosystem can exist as long as confidence exists. Confidence that if needed, metal could be delivered and that price discovery is honest enough to trust. But when physical demand concentrates in places that actually take delivery, the paper price gets challenged, not with a tweet, with a premium. If one region consistently pays more for real bars, the market is telling you something. The global price is not actually global, it's local. It's where metal changes hands. And recently, that premium has been glaring. In some Asian hubs, buyers have been paying significantly above the headline price you see on Western screens. Even after adjusting for local taxes, there's been a persistent gap that suggests physical tightness and strong end-user demand. Why does that matter? Because arbitrage should close that gap unless it can't. Arbitrage fails when shipping is restricted, when export rules behavior, where metal produced domestically is kept domestically. Now, if you're a buyer, you have to decide whether you want to be early on time or late. Late is the most expensive, but being early does not mean being reckless. It means being steady. It means dollar cost averaging. It means not chasing every spike. It means keeping a calm mind while the market tries to hijack your emotions. And yes, there will be days where silver gets slammed. There will be headlines that declare the bull market over every time it drops a few dollars. That's how the game is played. The difference this time is the macro backdrop and the supply chain reality. Now, I want to turn this into a conversation with you because your experience matters. Have you noticed higher premiums or longer delays where you live? And do you think government policy, export restrictions, industrial priorities, currency decisions is now the main force behind the silver story? Drop a comment and tell me what you're seeing, because the on-the-ground data from viewers often shows the real situation before official numbers do. And here's the second question. If the paper price stayed flat for 6 months, but physical premiums kept rising, would you still trust the screen price? Or would you treat the premium as the real message? I want to know your answer in the comments. Now, as we close in on the end, let's summarize without losing the urgency. 1. Political pressure on monetary institutions weakens confidence and metals respond. 2. The debt trap limits the ability to fix inflation through rate hikes, so currency dilution remains the path of least resistance. 3. Silver is uniquely positioned because it's both monetary and industrial. 4. Supply chains are being reshaped by governments and geopolitics, not just by markets. 5. Physical premiums in key regions signal tightness that paper markets can't fully hide. 6. Exchange rule changes and collateral demands can accelerate forced selling, but they also expose how fragile leveraged price discovery can be when physical reality tightens. And if you want to know where this goes next, you have to watch what the rule makers do, not just what the chart does. And 7. The biggest risk for most people is not volatility, it's complacency. It's assuming the system will behave the way it did in the last cycle, even though the structure has changed. So here's what I want you to do next. If you found this breakdown useful, subscribe to the channel right now because we're going to keep tracking these shifts and I'm going to keep translating the noise into a clear story you can act on. Hit the like button if you want more deep dives on supply chain disruptions, and share this with one person who still thinks silver is just a shiny rock. They might thank you later, because if this really is a government-led reordering of the silver supply chain, the next surprise won't be that price moved. The next surprise will be how quickly the old rules stopped applying. The shortage is fake, meaning the price is controlled. If retail is paranoid, people laugh. Phase 2 is inconvenience. Delivery takes longer, premiums widen, certain products vanish. People still laugh, but now they're annoyed because the boring thing is suddenly hard to get. Phase 3 is shock. A headline hits that confirms what the physical market has been whispering for months. A policy change, an export restriction, a major buyer stepping in publicly, an industrial user admitting they're scrambling, a warehouse report that doesn't reconcile, something breaks the spell, and when phase 3 hits, the crowd doesn't calmly allocate. The crowd panics, they all rush at once. That's why the beginning feels slow and the middle feels violent. So if you want to position like a grown-up, you have to do it in phase 1 and 2, not in phase 3. Phase 3 is where the clickbait lives. Phase 1 and 2 are where the opportunity lives. Now, let's go deeper into the government-led angle, because this is what makes the story bigger than just a metal rally. When a government labels something critical, it gains an entirely new set of behaviors. It can be regulated, rationed, taxed differently, subsidized, prioritized, stockpiled, or restricted. The government can lean on domestic producers. It can incentivize recycling. It can pressure refineries. It can direct procurement through defense or infrastructure programs. It can do all of this without passing a dramatic law that screams for attention. And that's exactly why the disruption feels invisible until it isn't. You might not see a headline that says, "We are restricting silver." Instead, you see small signals. A licensing process that slows shipments. A customs rule that suddenly tightens paperwork. A temporary review that delays exports. A procurement program that quietly absorbs inventory. An industrial policy that redirects supply to domestic manufacturers. Each one is small. You watch how quickly governments talk about resilience and security and domestic capacity. Those are code words that often precede restrictions. Now, here's a cliffhanger that should make you sit up. What if the next big move isn't a price spike, but a two-tier market? A two-tier market is when the headline price exists, but the real price paid for immediate deliverable usable metal becomes meaningfully higher. You already see hints of this. Physical premiums, regional gaps, different pricing hubs, that's the early stage. If that spreads, you end up with a world where people talk past each other. Traders say silver is X. Manufacturers say no, silver is X plus a big premium and we can't even get enough. Retail buyers say it's out of stock or back ordered, and the headline price becomes less relevant to anyone who actually needs metal. That would be a major psychological shift, and it would change how people behave. Because if you can't trust the posted price to reflect availability, then you stop waiting for dips that never come. You start securing supply. Now, let's address the fear word that people whisper when they don't want to sound dramatic. Hyperinflation. Let's be careful here. Hyperinflation is not prices went up. Hyperinflation is a collapse in confidence where people race to exchange currency for anything real as fast as possible. It's psychological as much as mathematical, and it usually happens when authorities are trapped and choose currency creation over honest adjustment. Does that mean it must happen? So consider what silver touches: electronics, solar, medical applications, defense systems, communications, energy transition infrastructure. You don't need a conspiracy to see why governments would care. You just need a spreadsheet of where silver is used. Now combine that with a world where alliances are shifting, trade routes are contested, and countries are competing for industrial resilience. The supply chain becomes a weapon and a shield. Whoever controls resources controls options. So yes, I believe you're watching governments realize that silver is not just a commodity, it's a lever. And here is where the retail investor gets stuck. You don't get invited to the strategic table. You don't get to call the warehouse and reserve the next shipment. You live downstream of those decisions. That doesn't mean you're helpless. It means timing matters. It means if you wait until the disruption is confirmed on mainstream media, you're likely waiting until after the disruption is already priced in, because the market always moves first and the explanation comes later. Now, let's inject one quick practical segment here, because a lot of you ask, what do I do with this? First, don't leverage. Silver will humble you if you treat it like a slot machine. Second, think in terms of accumulation and allocation, not day-to-day prediction. Third, if you're buying physical, focus on reliability, liquidity, and premiums. The cheapest premium is not always the best deal if delivery is uncertain. And fourth, if you're looking for silver-related success stories, real people who built wealth, survived inflation, and made smart moves during chaotic cycles, there's a separate channel linked in the description. Give it a look and subscribe over there too, because sometimes the best motivation comes from seeing what others did right when everyone else hesitated. Now, back to the main thread, because we still need to connect a few more dots. One dot is the constant attempt to scare people out of metals using calendar events, commodity index rebalances, seasonal weakness, a sell in May. You've heard the stories. Sometimes they matter at the margin. Often they're used as narratives to shake weak hands. The key is to ask, does a calendar event change the physical deficit? Does it change the strategic demand? Does it change the debt trap? If not, then it's a short-term noise story. It might cause volatility, it might create buying opportunities, but it does not rewrite the structural setup. Now, there's also the institutional angle. When large allocators start rotating away from bonds and toward hard assets, that's not a meme. That's a reflection of expected real returns. If real rates are negative, meaning the return you get from safe paper is less than the inflation you actually experience, then safe becomes guaranteed loss. And people don't like guaranteed loss. They look for alternatives. Gold is one, silver is another, productive assets can be another. But the point is, the flow begins. Hand flows are what drive prices at the margin. Now, here's a cliffhanger you need to keep in mind, because it could define the next phase. What happens when industrial users start competing with investors for the same ounces? Up to now, a lot of investment demand has been absorbable because investors can be distracted, they can be shaken out, they can be convinced to wait. Industrial users cannot wait. They cannot pause production because a headline says sell off. They have orders, contracts, and deadlines. So if a supply chain disruption tightens further, industrial demand becomes price insensitive at the margin. They will pay up because the cost of not having silver is higher than the cost of paying more. That's when price dynamics change. That's when you can see step changes rather than smooth climbs. And that brings us to the question of availability going forward. If supply remains constrained and demand remains elevated, availability will look like this: higher premiums, longer lead times, more frequent out-of-stock notices, more pressure on official programs. It will also likely look like tighter export rules and more national preference. Block flow when inventories are spoken for, when delivery timelines stretch, or when the metal simply isn't there at the posted price. So you have to ask, if the gap isn't closing, what's stopping it? That question is the beginning of the real story. Now, while all this is happening, the exchanges are also adapting. Margin requirements, position rules, collateral formulas, these are boring topics until they aren't. Because when margin rules change, they change who can play, how much leverage can exist, and how quickly positions can get forced out. If an exchange increases the percentage of total value required as collateral, volatility gets more expensive. That can wash out reckless leverage. It can also squeeze participants who are relying on thin margins to stay in trades. It affects longs and shorts, but it hits the weakest hands first. And there's an uncomfortable irony here. The more the market moves, the more expensive it becomes to hold positions. That means the moment the crowd rushes in, the rules can force the crowd back out. It creates whipsaw dynamics that punish emotional traders and reward patient holders. So when people ask, is the market becoming more fair? The honest answer is, it becomes more disciplined. But discipline doesn't feel fair when it liquidates you. Now, I want to address the big fear that always shows up when silver runs. What if this is the top? It's a fair question. It's also the question that keeps people underexposed during secular moves. The trick is to separate prices as up from conditions have changed. If the conditions that drove the move are still present, debt, stress, currency dilution, supply deficits, strategic hoarding, then the move is not just a spike. It's a re-rating. It's the market revaluing reality. Could there be sharp corrections? Absolutely. Silver is volatile. It always has been. But volatility is not the same thing as reversal. Here's what matters. Does the world have a reason to want more silver? Yes. Does the world have a reason to restrict silver increasingly? Yes. Does the mining pipeline easily expand? No. Does recycling instantly solve it? No. Do paper claims guarantee physical supply? Not when physical is prioritized elsewhere. So the question becomes, what price resolves that? What price clears that? Nobody can tell you the exact number on the exact day, but we can understand the mechanism. Price must rise until enough holders sell and enough new supply is created. If holders refuse to sell and supply cannot expand quickly, price has to keep pushing. Now let me bring in something most people ignore: the behavior of mints and official coin programs. When official coin production gets limited, delayed, or allocated, that's not always because metal doesn't exist. Sometimes, well, it's because the issuer is managing distribution. Sometimes it's because blanks are constrained. Sometimes it's because the mint is prioritizing other programs. Sometimes it's because demand is too hot and they're smoothing it out. But to the buyer, it looks like scarcity, and scarcity changes behavior. People stop waiting for dips. They start buying availability, and that behavioral shift is what turns a bull move into a stampede. Now, I want you to imagine what happens if the next leg up begins. While retail inventories are already thin, while delivery times are already stretched, while the physical premium overseas is already elevated, and while exchanges are already tightening the leverage screws, that's the kind of environment where price can gap. That's the kind of environment where narratives flip from nobody cares to why didn't I buy in a matter of weeks? And by the time the headlines catch up, the easy part of the move is usually over. Okay, now let's deal with ratios, because a lot of people use ratios as their compass. When silver outperforms gold, it tells you risk appetite is shifting in the metals complex. It suggests the move has broadened beyond purely defensive fear and into a recognition of silver's industrial leverage. When the gold to silver ratio compresses rapidly, it often signals the market is entering the hotter phase of a metals bull market. But here's the mistake. People treat ratios like a clock. They'll say, historically it was X, so it must go back to X. And then they'll force their portfolio moves around that assumption. Ratios can overshoot. Ratios can undershoot. Ratios can stay wrong for a long time. A better approach is to treat ratios as signals, not commandments. If the ratio is collapsing because silver is in shortage and gold is steady, that's a signal. If the ratio collapses because silver is in a speculative blow-off and fundamentals are weakening, that's a different signal. So the real question isn't what was the ratio a century ago. The real question is what's driving it now. And right now, the drivers include industrial demand, supply deficits, and strategic accumulation. That's not a normal setup. Now, should someone rotate some silver into gold after a huge run? If you're heavily concentrated and you want balance, that can be reasonable. But if you're selling silver to sit in currency, you're not rotating. You're stepping out of the story into the thing the story is about. And I want to connect that to a broader point. Cash is not neutral in an inflationary environment. Cash is a position. It's a bet that purchasing power will hold. If your bet is wrong, you don't just miss upside, you lose ground. Now, there's another layer to this that doesn't get discussed enough: regional demand and the pricing mechanisms. In some Western markets, price discovery still leans heavily on futures and paper. In several Eastern markets, price discovery is more directly connected to physical flows. When those systems diverge, you get stress points, you get premiums, you get export controls, you get sudden rule changes, you get temporary suspensions, you get whatever is necessary to prevent metal from leaving. And when you see export restrictions on a critical input, that's usually not about abundance. It's about priority. It's about keeping the stuff at home. So if you are watching restrictions and thinking that shouldn't matter, understand that it matters because it reveals intent. It tells you decision makers believe the resource is strategic, and once intent is revealed, the market starts pricing that intent. Now, let's be clear about what a government-led disruption looks like on the ground, because this is where the story becomes real for everyday buyers. It looks like available, but only in certain sizes. It looks like we can get it, but not quickly. It looks like premium changed overnight. It looks like allocation rules. It looks like we need extra verification. It looks like shipping has restrictions. It looks like we can quote you, but the quote expires fast. And yes, it also looks like a strange situation where people are selling back metal, but the supply still feels tight because the pipeline is clogged and the distribution is uneven. Now, I'm John AG, and I want to slow down for a second and walk you through a sequence that almost nobody talks about, but it explains why these stories turn viral when they finally break into the mainstream. It usually happens in 3 phases. Phase 1 is denial. The metal is boring and